Welcome to the debriefs for the Section B of the FM mock. My name is Jo Tuffle and I'm the expert tutor for the ACCA.
This question, select the correct combination from boxes 1 and 2 regarding the payouts related to the forward rate agreement if the interest rate on the loan is 6.5% when it is taken out. So we now have to evaluate this forward rate agreement for this 50 million loan in 4 months' time for a period of 8 months. So the loan is 50 million in 4 months for 8 months. So the applicable FRA starts in 4 months and ends in 12 months because we need it to be for 8 months. So 4 plus 8 equals 12. So we're going to be using this FRA. So the FRA therefore is at 7.3%. Our loan is at 6.5%, which is lower. So we're going to have to pay out to the bank on the FRA because our loan is lower than the FRA. And what we'll have to pay out is the difference between the two rates. So 7.3 minus 6.5 is 0.8. And we need to times that by the 50 million times by the term of the loan over the 12 months, because that 0.8 is going to be paid for 8 months and it's an annual rate. So in the calculator, the 0.8 is a percentage, so you need to divide that by 100 to get a decimal. And then we times that by the 50 million. And then we times that by 8 divided by 12. And the answer is 266,667. So when we select the box, remember it's going to be Tudor pays the bank, and it's 26667. The distractors there are the 200 if you'd used the other FRA, and the 400 is if you didn't pro rata the interest rate for 8 months. You kept it at 12 months. Next question says, using exchange rates based on interest rate parity, what is the dollar income received for the project? Well, the interest rate parity is a formula on your formula sheet. So it's the second one of those at the bottom. Interest rate parity says the forward rate is the spot rate now times by 1 plus interest in the counter currency divided by 1 plus interest in the base currency. So we need to work out what is the base currency and what is the counter currency. And we need to then apply interest rates to that spot rate to get the forward rate. Now we need a 6-month rate and a 12-month rate. If you read the scenario again, they're going to be receiving 200 dirhams in 6 months' time from today and 400 dirhams in 12 months' time for today. And the current spot rate is 4 dirhams to the dollar. So dirhams is the counter currency and the dollar is the base currency. We've then been given those short-term interest rates per year, dollars and dirhams. We're now ready to calculate those forward rates to be able to convert the dirhams into dollars, add them together and see what the income is from the project. So using the formula, and the base is the dollar and the counter is the dirhams, we've got the 12-month rate to do first, which will be 4 times 1.08. Remembering we need to put the interest rate in as a decimal, divided by 1.06. So the rate is 4.0755. Now we need to do the 6 months rate. And we need to therefore divide by 2 the annual rates. So 4 times by 1.04, halving that dirham rate of 8, divided by 1.03. And we get 4.0388. We now need to use those rates on the correct numbers. So the 12-month rate is to be used on the 400. So 400 divided by, because you're converting from the counter currency to the base currency, you need to divide by that rate, 4.0755. And that was going to be 98,147. So I'm going to pop that next to it, 98.147. And then we're going to do the 6 monthly one. And then we're going to take the 200 and we're going to divide by 4.0388. And that is going to be 49.519. I'm going to now add the 98 to that, and we get 14766. So to the nearest million, that'll be 147.7. So there's your answer, the second one in the line. Now the distractors are there if you had used the rates the wrong way round, or if you had potentially not found a 6-month rate and just used one rate. Your answers will be there if you make those common mistakes. So the next two questions are now discursive questions. The first one says here, Tudor company is unsure whether to use a forward contract or a money market hedge, and is comparing the relative advantages and disadvantages of the two. Which two of the following statements are true? The forward contract and the money market hedge have the advantage of being precisely tailored to Tudor company's requirements. Absolutely. They're over the counter and they're bespoke, and they're precisely tailored to their requirements, which is good. Number 2, Tudor company will be obliged to fulfill the forward contract, whereas the money market hedge could be traded on and exchanged to another party before settlement. No, they're both an obligation, and you cannot trade either. So therefore, the forward contract, although it says is an obligation, is true. The money market hedge, saying it can be traded on, is not true. So the second selection is not correct. Third selection, the forward contract will result in an effective rate of exchange being fixed, whereas the money market hedge will allow Tudor company to benefit from a favourable movement in an exchange rate. Again, it is effectively a fixed rate, so the forward contract is true, but it's also an effective fixed rate for the money market hedge. You manufacture a forward rate by doing a money market hedge. You cannot benefit from a favourable movement in exchange rates. It does not have an option, it's an obligation. So that one isn't true either. So the final one is also true. The forward contract will result in Tudor company receiving a dollar equivalent of dirhams in 6 and 12 months' time, whereas the money market hedge will provide Tudor company with dollar receipts today. That is true. So we're going to select 1 and 4. The next question, in relation to the yield curve, which of the following statements are correct? Number 1, expectation theory suggests that investors require increased compensation as maturity increases due to risk. So there are 3 explanations of the yield curve: liquidity theory, expectations theory, and market segmentation theory. Number 1 is not a correct explanation of expectation theory, because that is a correct explanation of liquidity preference theory. Liquidity preference theory says yields rise with maturity, as investors require more return for the risk of money being tied up in the longer term. Expectation theory means yields rise with maturity due to investors expecting an increase in underlying interest rates in the future. So number 1 is incorrect. Number 2, an inverted yield curve can be caused by government action to tackle high inflation. Now, tackling high inflation will mean interest rates are higher in the short term, with an expectation of a fall in the longer term. So the curve is inverted. So number 2 is a correct explanation of that, and that is based on expectation theory. Number 3, a kink in the normal yield curve can be due to differing yields in different market segments. That is a correct explanation of market segmentation theory, which explains a kink because the markets are separated, and so a kink would happen between those two markets, in the short-term maturity market and the long-term maturity market. So the correct answer is 2 and 3 only.